very good afternoon, guys. Continuing with tax, and today we take the next chapter, one of the most important chapter of your syllabus. When I say important, matlab, this chapter has got the highest weightage as far as your board exams is concerned. In the earlier attempts, 22 marks has come from this chapter in the form of compulsory question. Compulsory means without option 22 marks has come, and with option around 37 to 40 marks you can expect. There was 15 marks ka 2 question attempt any one plus another 7 to 8 marks. So with options, as far as the sums are concerned, 37 to 38 marks with options, another 3-4 marks ka objective. So around 40 odd marks from this chapter with option. This chapter and the previous chapter what we did, registration, you can easily say that without option, both the chapters contribute around 50 to 60% of your paper. And one good advantage, both from student point of view, are very interesting and very schooling. This is the chapter which is going to take maximum number of time as compared to your other chapters. The reason is earlier this chapter was divided into input tax credit and payment of GST. Now it has been clubbed, because when you do calculation of payment of GST, when you pay, you have to adjust the ITC and then only pay. That is the reason now it has been clubbed. Okay, so we start with that. ITC, that is input tax credit. In the chapter introduction as well as in registration, I am giving you all examples. What exactly do you mean by ITC? I'll give you a similar example before I start this chapter. Initially, I'll be discussing few definitions and one question where there are very important points for ITC ka concept, which is applicable not only from theory point of view but also from sums point of view. Okay, what I'm giving you all example I have already discussed with you all, but since we are starting this chapter, again I will brush up. Okay, you are purchasing goods. Okay. The basic value of goods is say 20,000. Now you are purchasing goods from a registered dealer who is going to charge you 12% GST. 20,000 ka 12% gives you 2,400. So you will pay to the seller total 22,400. Now what the seller will do? He will take from you 22,400. 20,000 is his money. He will keep it with himself, and this 2,400 he will deposit to the government in the form of GST. GST can be IGST, CGST, SGST, UTGST, depending upon the place, that we will see in detail in the second half of this chapter. So he will take 22,400, 20,000 he will keep it with himself, and 2,400 he will deposit to the government. Now, the person who has bought this, from his pocket how much has gone? 22,400. From his pocket 22,400 has gone, 20 gone to the seller, and 2,400 gone to the government in the form of GST. Now, obviously this fellow has purchased goods for business, so he is going to sell it to somebody. If he is a trader, the same goods he will sell it, and if he is a manufacturer, this will be a raw material, he will convert into finished goods and sell it. Now let's take an example. These goods which he bought for 20, again very important, 90% of this, no, not 90, to be honest, 98% of the students, and I won't hesitate to say half the professors also don't know, when you record this entry in your books of accounts, you have paid 22,400. If you are a dealer who is registered under GST, when you pass the entry, you will not debit purchase account by 22,400. You debit purchase account by 20,000, and this 2,400 is debited to an account called as input GST. If it is IGST, input IGST. If it is CNS, half input CGST, half input SGST. So this 2,400 is debited to GST account. Now in FYJC, they have added couple of sums also in the new syllabus where GST ka transactions are there. Okay, coming back. Purchase cost is 20,000. Because since you have debited purchase, you will not take this as your cost. Yes, but if the person, he is not a dealer who is registered under GST, then for him the cost is 22,400 only. Because he is not registered, so nor he will open GST account, nor while selling he can collect GST. Coming back to the example, this 20,000 ka goods, obviously he is doing business, so he will add the profit and sell. Let's take an example. He decides to sell this at 25,000. Now, if he is selling, he is registered, he can collect GST, assuming the same rate, 12%. Okay, 25,000 ka 12% if you take, it is 3,000. So he is going to sell it for a gross price of 28,000. Now what will happen? When he bought, he paid 22,400. When he sold, he collected 28,000. Now what will happen? On this collection of 28,000, 25,000 he will retain. This 3,000, now understand this very carefully. This 3,000 he will deposit to the government. But this 20 is the same goods what I purchased. Here already you have paid 2,400. Already you have paid 2,400. So now you will not deposit 3,000. From this 3,000 you will deduct 2,400 and the balance 600 you will pay to the government. So what you will do? 3,000 is the tax collected on sale. From that, you will deduct this tax of purchase. So the balance 600 will be paid to the government. Now listen very carefully. The advantage of GST. Government kitty did not get affected. Government got 3,000. How? When you bought it, you paid 2,400 to the seller. He paid 600 to the government. And now how much you paid to the government? 600. So how much government got? 2,400 here plus 600 here. So government got 3,000. Now see what is the advantage for you. You collected 3,000, of which now you are entitled to keep 2,400 with you. Why? Because already from your pocket 2,400 has been deposited to the government. So now this 2,400 what you paid indirectly, now you will retain it because you have collected from the customer what you have already paid to the government. Now you will just pay this difference. So the name of the chapter, input tax credit, is nothing but what you paid, that adjustment you do. So in this example, this 2,400 is nothing but your input tax credit. So input tax credit is nothing but, indirectly you can say, credit paid on purchase of goods or services which further you are going to use it for the business. Very first day there was advantages of GST. It removes the cascading effect. Cascading means what? You have already paid 2,400. So now you will get a deduction. Because if you pay this 3,000 to the government, government got double revenue. They got 2,400 here also. They got 2,400 here also. So that is the reason this is deducted, to reduce the tax burden, cascading effect, to avoid tax on tax. So this is the basic meaning of input tax credit. Later on, in the second half of the chapter, here in this chapter, we are supposed to do around 30 odd illustrations, 30. Of that, the second half, say around last 15-16 May, there are calculations where we have to do all this. We have to find out a tax on sales, we have to find out a tax on purchases, we have to see what is ITC, and then calculate the net amount payable to the government or recoverable from the government. So this is called as ITC. Audit, the basic meaning. Now starting with there are definitions. Just 5 minutes we'll glance on that. And after that, there are important conditions where how to decide whether you can claim ITC or no. Because the first 10 to 12 illustrations are illustrations where we have to decide whether ITC is available or no. Okay? Again repeating, a very, very important as well as a scoring chapter, and the chapter which has got the highest weightage in terms of marks as far as your board exams are concerned. Okay, let's start with the definition. Come to that page 117, aggregate turnover. No need to do. The reason is already this was there in earlier 2 chapters. This was there in introduction also, this was there in registration also. Same wording, so you can just skip it, already done. You can write in the side, already covered in registration. Then see, second, capital goods. Now if you see now one good advantage, all definitions are under section 2. Brackets में there is subsection. So if you can remember the subsection, fine, otherwise it's okay. Okay, now what is capital goods? I just brush up the meaning and then you all can study on your own. Capital goods is nothing but, in simple words, assets. When I buy goods now to be sold, that is called as inputs. But when I buy assets for business purpose, fixed assets, then they are called as capital goods. So capital goods are not input. Input means normal goods which we further sell or we use it for production of goods. But capital goods means nothing but assets. Later on you can just read it on your own because it's very self-explanatory. Next, electronic credit ledger. Now in the next semester, again you will have 25% of GST. In that there is detail of electronic cash ledger, credit ledger, short notes. I'll just show you the meaning, basic meaning. What I discuss here, 2,400 is your input tax credit. So where whatever is the credit amount, that as per the GST laws, there is a separate, you can say as good as a book, that is called as electronic credit ledger. That means online transactions where whatever tax you have paid, you are eligible to take the credit, all of them are recorded at one place, that is called as electronic ledger. So it is a record maintained where all your input tax credit are listed, simple words. Then exempt supply. Exempt supply means sale of goods or provision of services where there is no GST. It is 0 rated, it is nil rated, or it is not liable for GST. Same we had done earlier. Next, input. Input means the goods what you purchase, but see what is given there in A point. Other than capital goods, because capital goods has already come in point number 2 above. So capital goods are your fixed assets. Input means normal goods which you are going to use for your business purpose. Either you buy and sell it straight away, or you buy goods in the form of raw material, convert into your finished goods, and then you are going to sell it. Okay? Next, input service. The difference between input and input services, the word only input is applicable for goods. And when I say input service means you have taken services from somebody. You are constructing your office, you have taken service of an architect. So architect will charge you GST. And since you are paying him for designing of your premises or alteration, you will get the credit of that. So only input pertains to goods, and input service means the tax paid for the services which you have received. Next, 7th, input service distributor. Again, input service distributor means supplier of goods or services where he receives a tax document. See here, You can claim this only when this is in a tax document. In the chapter documentation, we discuss tax invoice. So only where there is tax invoice, there only credit can come. And tax invoice can come only when there is a registered dealer. So the person who takes tax invoice and then takes the credit of GST and passes on, that person is said to be an input service distributor. Only if you come in that category, then only you can claim the credit. You can read it in and write it in your own words. Let's not get into that. Okay. Input tax. Straight away in the example we have. Input tax is the tax which you have paid on purchase of goods. In this example, input tax is 2,400. Input coming in, purchases coming in. So the tax paid on purchases is input tax 2,400. Okay. Next, input tax credit. See here, I paid 2,400 on purchases. Just see here, I deducted 2,400. So this is, understand the difference, huh? This is input tax and this is input tax credit. Fortunately, in this sum both are same. But there are few conditions. Even though you have paid tax on purchases, you cannot always claim this. There are certain conditions which we'll see in the next 15-20 minutes. There are certain conditions where you cannot claim it. So input tax is all the tax what you have paid on purchases, and input tax is credit is that tax which you can claim credit as per GST laws. All input tax credit cannot be claimed, keep that in mind. This amount may be equal to this or it may be less than that. Okay? But it is not possible that input tax and input tax credit will be the same. Next, non-taxable supply. Non-taxable supply means supply of goods and services where there is no GST only. GST is not applicable. Now see, output tax, outward supply. What was this? Input tax. Input tax, see that is I have not rubbed this and I have given this example because half the definitions I can cover here only. Input tax was what? Tax paid on purchase of goods. Input, I buy. Output, going out, I sell. Tax collected on sales is output tax. Tax paid on purchases is input tax. Output supply, the value of goods sold, that is your output supply. Output supply means selling the goods and the value at which you sell, that is the value of outward supply. 14. Taxable person. The person who is registered and deals in goods where there is GST, that person is called as a taxable person. And taxable supply means supply of goods and services where GST is applicable. Because you all know there are many goods where GST may not be. Got it? So all definitions are straightforward. You can just highlight the headings and write it in your own words. Just try to remember one good advantage, all are section 2, only brackets may, the subsections are different. If you can remember, fine, otherwise it is okay. Got it? Now see, this was the first part of the theory definition. Now we come to the most important part of this chapter. What are the conditions where you can claim ITC, that is input tax credit? As I mentioned, all taxes paid on purchases are not eligible for credit. There are certain conditions under the GST Act. Only if you fulfill those conditions, then only you can claim ITC. Now I will make this chapter very simple for you all, and I am telling you 99% I am sure that the only way you can lose marks here is by making silly mistakes. There is no other way. Okay? So we will do according to that. Now come to the next page. Forget that table. See the first part. Eligibility. Already I discussed. Only a registered person. The first criteria to claim input tax credit, you have to get yourself registered. only a registered person can claim. If you are not registered, see, you will pay this even if you are not registered. So if you are not registered, the seller will charge you this. If you want to claim this, then you have to get yourself registered. Remember in the previous chapter registration, I told you, when we came to the discussion of voluntary registration, I told you there are certain categories of dealers who are not liable for compulsory registration, but if they want to claim ITC, then they can opt for voluntary registration if they want to. So many people, even though they don't fit in that turnover criteria, they opt for voluntary registration to claim input tax credit. So the first important criteria, the person has to be registered. Okay, just listen to what I say. Side by you all can write it in your own words, don't worry. Even if they ask you a 15-mark question on this now, you can easily write. Let's continue. Second, conditions. Now see, A, possession of tax paying document. This bill, when you made the payment, see, many things will be explained on the basis of this example only. You paid this 22,400. When the seller has collected GST from you, he has to issue a tax invoice. If he has not issued a tax invoice, you cannot claim ITC. So the first thing is that when you buy the goods and you want to claim ITC, there has to be a tax invoice. Tax invoice is a proof that these goods are liable for GST and it shows the amount of GST collected from you. So the first condition is tax paying document has to be there. Details of supplier. We discussed in documentation chapter. When a tax invoice is made, all the details comes. The person who sells, uska name, address, email ID, GST number, at the same time the person to whom you are selling. So that second part is not that important. Tax invoice is there, automatically details of supplier will be listed in the tax invoice. Now the B part, you just need to see that first line. Heading only says receipt of goods and services. There are two small sums, very interesting sums. If you get in the exam, it will be bonus. It will come in the next part. Now, if you want to claim input tax credit, if you are buying goods or if you are receiving services, only when you receive the goods, you can claim ITC. Only when you have received the services, you can claim ITC. Again, coming to the same example. Buyer has paid 22,500. He has paid the bill, he has made the payment of bill, but he has not received the goods. So till the time he has not received the goods, he cannot claim ITC. So to claim ITC, goods have to be received. There are 3-4 sums where the seller has sent you the goods. On the way they have been damaged, lost, you cannot claim credit. To claim credit, you should physically receive the goods or you should avail the services. Okay. Next, see, tax charge is paid to the government. Same example. Tax invoice. You have paid this. Now listen up. You just cannot claim this 2,400. What I told you. You have paid 2.4 to whom? To the government. Now, you can claim this only if this amount has gone to government. I'll tell you practical example. There are many people against whom there were criminal cases before GST. What people used to do? Collect 2,400. Now what happens? If I am the purchaser, I get a tax invoice. Say I have made this payment. Now I am under the impression that this 2,400 has gone to the government. There are people who have done this. They take from the, say they take from me 22,400. They will keep this also. They will not pay to the government. So I will not come to know till the time I am not registered. So now if I am registered, I will take the credit. If I don't get the credit, that means I know there is some problem. So that is another criteria. So registration has to be there. Tax paying document. At the same time, the tax which you have paid, it has to go to the government kitty. What I told you, government got 3,000. How? 2,400 here and 600 here. So till the time government doesn't receive this 2,400, you cannot claim ITC. Whatever points I'm explaining now, almost every sum has one point of this type, so it will become very simple for you. Mark this very important, not only from the theory point of view, but also from sums point of view. Okay? Next, furnishing of return. Every dealer, every service provider who is liable for registration has to file the return. If he has not filed the return, he cannot claim GST. Again, return of GST you all have in the next semester. That time we will see in detail. Next, goods received in lots of installments. Again, there are a couple of sums based on this, very interesting. When I say goods received in lots of installments, that means what? Say I have placed an order, 5,000 of X units. Now, the supplier tells me, I will give you all 5,000 but not together. Understand this example, very interesting. Two sums get covered here only. I have placed an order of 5,000 units. He says, I will deliver all 5,000 units to you, but it won't be possible for me to deliver together. First week, every week, I will give you 1,000 units. I say, okay, I don't have a problem. Now, he will send you a bill together. Or, even if he sells you bill part by part, you will claim the credit only when the last installment is received. I am getting 1,000 in 5 parts, same order. I can claim credit only when I receive full 5,000 units and not in part. This is applicable only where the transaction is such that you are going to get goods in installment. It is applicable there only. So if you are going to get goods in installment, you will claim the credit only when you receive the delivery of the last installment. Okay? There are two sums based on this. Next, payment if not made within 180 days from the date of invoice. See here, this fellow has charged me 22,400. I have to make the payment to him. If I don't make the payment to him within a period of 6 months, precise 180 days, then I cannot claim the credit. The payment, customer has to pay to the supplier the payment within 180 days from the date of bill. Otherwise, he cannot claim ITC. If he delays, then suppose he makes the payment after 2 years, then you can claim the credit after 2 years. But not just giving an example, not now. So if you want to claim the credit, the payment has to be made within a period of 180 days. There are sums based on this also. Next, recredit if the payment is made subsequently. Same example what I told you. If you make the payment after 200 days, then you will claim the credit after the payment is made, not within that period where you couldn't pay. So if you have taken the credit, you have to pay the money back to the government, and later on when you make the payment to the supplier, again you will take the credit. Taking the credit again is called as recredit. Recredit means you had taken credit once, but because the credit couldn't be taken, it was reversed. Now again you have made the payment, so again you can take the credit. That is called as recredit. We will see detail में समझेंगे. Next, fourth, ITC not admissible if depreciation claimed on tax component. Now sometimes you buy assets, correct? Now when you buy assets pay also there is GST. Now just take an example. You are buying an air conditioner for business purpose. One other important factor, it will come later on, maybe in this also will come. GST you can claim only for those transactions or those purchases and services which are going to be used for further. That means you are going to use it for your business purpose. Now see this point. Suppose I am buying a AC for 50,000 rupees. 12% GST. 50,000 ka 12% 6,000. So how much I pay? 56. Now when you do the accounting, here there are two ways. This was purchase, so I debit purchase account. This is purchase of a fixed asset, so I will debit air conditioner account. Now see, you are allowed to do this. When you record the entry in the books of accounts, you can debit AC by 50,000 or you can debit AC by 56,000. It's fine. But this 6,000 ka credit you can claim only if you have debited AC by 50. Because if you debit AC by 56, what will happen? Every year you will claim depreciation on 56. And here you will claim depreciation only on 50. SY ka tax, direct tax. Those who are with me, I have repeated this statement again and again. Tax paid once cannot be paid paid twice. Same way, benefit taken once cannot be taken again. So, if you are taking the benefit of depreciation on this, you cannot claim the benefit of input tax credit. So, either claim depreciation or claim ITC, whatever you want. So, if you have debited your AC by 56, you will not claim input tax credit. You will claim depre on 56. But if you debit your AC by 50, then you can claim input tax. Ultimately, the effect is same only. The only difference is here you can claim 6,000 one full year. Here you will have to claim it over a number of years. Got it? So remember, depreciation is not ITC cannot be claimed on depreciation if you have claimed depreciation on the amount of this. Next, time limit for availing ITC. Here also there is one illustration. Right now I'll just discuss the basic. Now see, understand this. Within what time you will claim ITC? See the A point. The due date. The due date of furnishing of return under section 39 for the month of September following the end of the financial year to which invoice relating to such debit note pertain, that is 20th October of next financial year. In short, it will be 20th October, because every month now, today 1 month gets over, you are supposed to pay GST by 20th of the next month. That you will have in detail in the next semester. So it will be 20th October of your next financial year, or the date on which you file your annual return. The due date of annual return is 31st December. So it will be 20th October or 31st December, whichever is earlier. But suppose you make the filing of return before 31st December, then it will be that date. Don't focus right now. There is one sum. In that sum, we will study in detail. You will get this exactly. Okay? And then you all can write it in your own words. Then see. Next point now. No. Come to the next page now. 121. There's a fourth point. Input tax credit in case of banking company and financial institution. Now I am keeping this on hold because I explain you now, you will not understand. There are two sums based on banking. I will solve both the sums on the board. When we solve that sum, you will not be required to read this also, you will get it in the sum only. Okay? So temporarily keep it on hold. Now here there are few points. Fifth one. Input tax cannot be claimed on the following situations. A. Motor vehicle and other conveyances. Now you cannot claim ITC on motor cars and other vehicles, but there are certain conditions. See those exceptions. A. If you are using the vehicle for further supply, that means transport companies indirectly, or transportation of passengers, or you impart training to be given to drivers or for flying and etc., then you can claim credit. That means if I am owning a vehicle, if either I am a transporter or I use it to give training to my drivers, then only I can claim, otherwise no. Here also there are sums. When we do the sums, you will find it very, very simple. B part. See the highlighted part, food and beverages. Now in companies, even in small businesses, some refreshments are given, tea, snacks, either like that or some occasions or meetings and all that. So when there are expenses incurred on refreshments, you cannot claim income tax credit because it is not for the furtherance of business. But yes, if you are a caterer, your day-to-day business is providing tea, snacks, coffee, lunch, dinner, then you can claim. Keep this point in mind. Okay? Then, see that second part. Club membership. No ITC on club membership or health and fitness centers. Then C. Rent a car, life insurance, health insurance. Now here there are exceptions. You cannot claim ITC if you are doing it voluntarily. That means if you take out health policies of your employees out of your own wish, then you cannot claim uska ITC. But if you do it under a government order, then you can claim ITC. So where you are providing vehicles to the staff for drop and pickup, or health insurance policy, if it is compulsory, mandatory as per the government rules, then only you can claim ITC. Then straight away come to below. D point. Goods or services both received by a taxable person for construction of an immovable property. If you are constructing your own immovable property, that is like building, then in that case you cannot claim ITC. But if you are buying a plant and machinery, or you are constructing a plant and machinery, then in that case you can claim ITC. But immovable property, construction of a building, ground floor, first floor, second floor, you cannot claim. In the sums, that will be very clear. Next, E. Goods or services both on which tax has been paid, that is composition scheme. Composition scheme is a scheme where dealers get a benefit of paying low rate of tax. They will not collect tax on every transaction. When we do the chapter levy and collection of tax, in that we will see composition scheme in detail. Composition scheme mein sellers cannot collect tax because they are those people whose turnover is less than 1.5 crores. They can pay full tax together. So since they cannot collect tax on every sale, they will not claim ITC. So those dealers who are registered under the composition scheme cannot claim ITC. Okay? Then, goods or services or both received by a non-resident taxable person except on goods imported by him. Only goods which are imported by a non-resident person, on that only ITC can be claimed. This is more for theory, there are no sums on this. Now listen, this important point. Although it is given below, but it is very important. Goods or services or both used for personal consumption. ITC can be claimed only on goods and services which are used for business purpose and not for personal use. So only goods and services where it is used for business purpose and there is furtherance, then only you can claim ITC. And the H part already I discussed with you. Goods lost, stolen, destroyed, written off, or swept off by way of gift or free samples. What I told you, ITC can be claimed only when the goods are received. If you have not received the goods, you cannot claim ITC. Now when I say goods lost, destroyed, you have not received the goods only, na? So you have not received the goods, there is no question of claiming any ITC. So even when you distribute goods by way of free samples, you cannot claim ITC. Why? See here, how can I claim ITC? I deduct from my sales tax. Now when I am giving goods free of cost, I am not collecting any money towards sale only. So if I am not collecting any money, there is nothing to be deducted. So no ITC can be. Because when I sell, what I collect on sales, from that I will deduct what I paid on purchase only. But I am giving goods free of cost. I am not collecting anything. So I cannot claim input tax credit. Clear? That is the thing. And yeah, that's it. I point is not that important. That's it as far as this theory is concerned. Mark this very important. There are few other points which I will discuss when we come to the illustration. So what I discussed in this video, starting the first part definition and the second part what we did right now, very important from theory point of view and applicable for 50% of the sums of this chapter. Okay guys, now I am breaking the video here. Now the rest of the thing what I am going to do in this chapter is all practical. You can expect another 5 to 6 videos from here minimum, where it will just be solving of illustration and sums only. Okay, so I'll just wind up this video here and I'll be back with the practical part.